Hi, welcome to the Complete Forex course. My name is Salman Sharif and I will be your instructor. This course covers everything that you will need to trade the Forex market successfully. Whether you're a beginner or have been trading for a while, you will definitely get something out of this course. It will take you from beginner to professional status. There are two course books that are included with this course. Forex Survival Manual on the trading of psychology and Infographical Forex. These are both included with the course, the digital versions. You can get the physical print versions if you like. Those are available on Amazon. The course will cover a lot of different concepts. These concepts, most of them will come with indicators that we're going to attach to our trading platform. The trading platform we're going to set up, and that's going to be completely free. And we're going to do that right after the lecture on Forex brokers. Then we're going to look at live charts using these indicators, and you're going to follow along with your own platform. So that's the best way you're going to learn, is doing it yourself. Okay, more about me. I've researched this market, Forex trading, for over 5 years now, and I've written two books. These two that I've shown you. I come from a financial background, and believe it or not, I was once a hedge fund manager. So now I'm trading Forex and teaching you how to. So in this course, you're going to get 5 years of experience, trial and error experience from a former hedge fund manager. Again, welcome to the course, and go ahead and download your course books now, and see you in the next lecture. Okay. Hi, welcome back. You should have your course books downloaded by now. The print ones, if you have those, go ahead and pull them out. Legal stuff. All right, we got to get through this. Turn to the page that looks like this and this right over here. The first one, just read through, and on the second page, the one that starts more legal stuff, we're going to read through it. Yeah, you can fast forward the lecture if you want. Use the button at the bottom. If you're the kind of person that just clicks the accept button when you get a terms of service or a legal document, those buttons are for you, so use them. Let's get started. Limit of liability, disclaimer of warranty, risk disclosure. This course is for educational purposes only. Past performance does not guarantee future results. Forex, futures, stocks, they all involve substantial risk. There is a potential for loss. Your trading results may vary. Trade only capital that you can afford to lose. We assume no responsibility for the information in this course. The next section, CFTC, U.S. government required disclaimer. Forex trading has large potential rewards and also large potential risk. You must be aware of these risks, and you have to accept them in order to trade in this market. Don't trade with money you can't afford to lose. This course is not a solicitation nor an offer to buy or sell Forex, stocks, options, futures. No representation is being made that any account is likely to achieve profits or losses similar to those discussed in this course. Past performance of a methodology or system is not necessarily indicative of future results. Substantial risk is involved. Trading has large potential rewards and large potential risk. You must be aware of these risks and be willing to accept them in order to trade in this market. Don't trade with money you can't afford to lose. CFTC Rule 4.41. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results do not represent actual trading. The results may have under or overcompensated for the impact, if any, of certain market conditions, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that the account will or is likely to achieve profit or losses similar to those shown. High risk investment warning. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment and therefore should not invest with money you cannot afford to lose. You should be aware of these risks and seek advice from an independent financial advisor if you have any doubts. Okay, we got through it. That concludes this lecture, and on the next one we're going to go over how to best use this course. See you there. Okay, this video is going to be on how to best use this course. I'm assuming you're just starting your journey into Forex trading. Maybe you had some success with it, maybe you haven't. Either way, you're going to get a lot out of this course. There's going to be a lot covered in this course. You don't have to master all of them, but you should become familiar with all of them because you're going to run into them at some point during your trading career. Okay, let's go over what this course is not. It's not a take this strategy, use it, make a lot of money. No, there's going to be a lot of concepts covered, but not specific strategies or systems that you use as a holy grail. This course is going to give you the knowledge to trade this market. With that knowledge, you can develop your own strategies and systems and become successful, get in that top 10% that is profitable. At the end of this course, you will have a full understanding of how this market works, what all the indicators are. You can go into any Forex forum and know exactly what the people are talking about, and you can put together your own strategies and confidently trade them. You want to develop your strategies based on what works for you. It's going to be different for each individual. That's the reason why no specific strategies are included, because it's up to the individual to find out what works for them. These factors would include things like your psychology, the time you have available to trade, which pairs to trade, what indicators to use, if any, your risk profile, your goals. That's a big one. Now let's get more into your goals. You need to set a goal for you this trading business that you're going to begin. Let's say hypothetically $1 million. Now treat this Forex business as $1 million business, even though your account might show $1,000 or even $100. This is $1 million business that you're beginning because that's what your goal is. Now, how much effort are you going to put into this $1 million business of yours? Probably a lot more than what you would put into a business worth $100. So I want you to write down on a piece of paper or on your computer background something like this, and just keep it there to remind you that you're operating $1 million business, or whatever number you want your goal to be. In the next lecture, we're going to go over what exactly this Forex thing is. Okay. Hi. This video is going to be on Forex. Forex stands for foreign exchange. The foreign exchange market is the largest financial market in the world. The reason that it exists is because different countries have different currencies and they need to exchange goods and the market gives them a place to convert their currencies. And Forex makes it easy for them to do that. So in the stock market, shares are traded. In the bond market, debt is traded. And in the Forex market, what's traded is money. Money is the object that is traded. We're going to trade money. When you buy a currency, you're buying a share of that country's economy using another country's currency. The exchange rate of the currencies is a reflection of the country's economic condition compared to the other country. Not only is it the largest market, it is also a decentralized market. What this means is no one single exchange controls it. There are entities that have some control over the currencies. These are mostly the central banks of those countries, and we're going to get into those in a later lecture, the one on market structure and players. So how big is this market anyway? Well, the largest stock market is the New York Stock Exchange. It has a daily volume of about $170 billion, give or take. Compare that to the retail portion of the Forex market, which is about $1.5 trillion daily. And if you look at the entire Forex market as a whole, it comes to about $5 trillion daily. That retail portion that I mentioned earlier, that is the spot transactions that occur, the speculators who decide whether it's going to go up or down. That's what we're going to be doing. So if this is your first encounter with the Forex market, then you're about to trade in the largest market on the planet. That's it for this lecture. In the next lecture, we're going to go over how exactly do we trade this market. See you there. Hi, welcome back. In this lecture, we're going to be covering ways to trade Forex. I want you to turn to the page that looks like this, and right there. And let's just get into it. The most common Forex transaction is the swaps. This is exchanging currencies and then reversing that exchange on a predetermined future date. It's not standardized, meaning it's not on any exchange, and therefore the parties make their own terms. Banks are the ones who participate in swaps mostly, so this isn't what we're going to be doing. What we'll be involved with is the spot market. It's simple, it's liquid, it's open 24 hours, and it has a low cost of entry. We'll go more into detail in that in a later lecture when we open an actual account. Some of the other ways to trade in the Forex market: futures, ETFs, options. Futures are contracts to buy and sell. They are traded on an exchange and are well regulated. ETFs, that means exchange traded funds. They also trade on an exchange and are most similar to trading stocks. You can also trade Forex options. An option is when a buyer pays a premium for the obligation and a seller collects that premium. They are traded on an exchange also, but there is less liquidity. There is another type of Forex options called binary options. This is fairly new, and a lot of the binary option brokers, a lot of times they're not regulated. You have to be very careful with binary options because in most cases the binary option broker only makes money when you lose money. Again, they only make money when you lose money. So basically it's like a casino. You might want to stay away from casinos. There are some reputable binary option brokers out there. We'll get into that on the lecture on choosing a broker. Now, don't let all these different types of ways to trade overwhelm you. We're only going to be focused on one way, which is the spot market. Although the analysis that we're going to be going over in most of these lectures is going to apply to any way you trade, we will still be sticking to the spot market because that's the type of account that we're going to open. Okay, so now in the next lecture, we're going to go over why we should trade Forex. See you there. Hi, this video is on why we should be trading Forex. I want you to turn to the page titled Why Trade Forex. Here are the reasons why you should be trading Forex. Number 1, low transaction costs. Your only cost is the bid-ask spread with most brokers, and other brokers, they would reduce that spread even more but add on a little commission. There are no exchange fees, no clearing fees or government fees, and depending on the broker, no brokerage fees. So should you choose a broker that charges a spread only, or should you choose one that charges an even smaller spread plus a small commission? Well, it depends on your trading style. If you are a swing trader or a position trader, your trades are longer term, and that means your spread really isn't going to affect your trade that much. So you should probably go with the broker who has the overall lowest fees. On the other hand, if you are a scalper, you're in and out of a trade, you're day trading, very short-term trades, you want a broker who has the lowest spreads possible. Even if they add a little commission, that's going to work out better for you if you're a scalper. Okay, number 2, no middleman. This also depends on your broker, and with a no dealing desk broker, it really is a no middleman. Your trade is sent directly to the market. The broker doesn't take a position against you with a no dealing desk broker. Okay, number 3, leverage. This is a good one. Let's compare it to stocks. With stocks, on a margin account, your leverage is about 2 to 1, meaning you can control twice as much as your account size. And if you're day trading, it goes up to 6 to 1. It's not bad, right? Now with Forex brokers, your leverage is 50 to 1, meaning say if you have a $1,000 account, you have control over $50,000 with that $1,000. And that's just for the US brokers. For any other place, that leverage goes up 100 to 1, 200 to 1, 500 to 1, and just imagine the possibilities there. And compare that to that 2 to 1 leveraged stock trading account that looked pretty good before, now, compared to a 500 to 1 leverage account. But you got to be careful with leverage. It goes both ways. Sure, there's a potential to make huge gains, but there's also potential to make huge losses. That could be a reason why in the US it only goes up to a maximum of 50 to 1. All right, number 4, trading times. Forex is a 24-hour market. You can trade anytime during the day, but you want to limit your trades, depending on your strategy, to the most volatile, where there's the most activity. This would be during the European session and the first half of the New York session. Also, the market closes, if you're in the New York time zone, it would close Friday afternoon and would reopen Sunday afternoon. So between those two times, the market is open 24 hours. All right, number 5, there is no fixed lot size. This means that you can trade whatever amount position size you want. If you have a micro account, your risk could be pennies. With the standard account, it's whatever you want it to be. The liquidity is there, whatever amount you want to throw at it, and also you can go as low as $25 or as high as millions per trade. The market won't even put a dent in it. All right, number 6, there is no market manipulation. This is a gray area. There is, of course, market manipulation in everything, but for Forex, what we're talking about is that no single entity controls the market. There are central banks that could influence the price of their own currencies, but that's usually temporary, and the world usually brings the levels back to where they should be. Just remember, the market is always right, whether it's a high price or a low price. It's at the price that it should be at. In the next lecture, we're going to go over the history of Forex, where this whole thing began. See you there. This lecture is going to be on the history of Forex. That's going to be on the page called A History of Forex, right there. And let's begin. Forex, or foreign exchange, has a long history going all the way back to biblical times. Back then, commission was charged to change money for people. Then, moving on to the 4th century, the Byzantine Empire has managed to create a monopoly on currency exchange. Then fast forward all the way to the 15th century, the Medici family opens banks in foreign countries to exchange currency, and they did this predominantly for textile merchants. Then in the 17th and 18th centuries, currency trading spread. Amsterdam made an active foreign exchange market, and agents conducted transactions from England, Holland. Then the gold standard monetary system was created in 1875. What this did is that it made governments guarantee that their currency would be able to be converted into gold. This required governments to have a substantial amount of gold reserves. Pretty soon all the major economic countries were on this gold standard. Then in 1913, half the world's foreign exchange was conducted with the British pound, and the amount of banks, forex banks in London, went from 3 to 71. Eventually, governments wanted to print more money than what they had in reserve in gold, and so the gold standard wasn't really working that well anymore. This started in World War I and then happened again during World War II. This brings us to the Bretton Woods Accord in 1944. The Bretton Woods Accord allowed currencies to fluctuate within a range of 1% to the currency par. It also made the US dollar the prime reserve currency in the world, replacing gold, and the US dollar became the only currency in the world backed by gold. The Bretton Woods Accord also created 3 international agencies. These are the IMF, the International Monetary Fund, the International Bank for Reconstruction and Development, and GATT, which stands for General Agreement on Tariffs and Trade. Then in 1971, President Nixon abolishes the Bretton Woods Accord. He did this because the US gold reserves was not enough to back all the currency in circulation. So much for that. And then in 1973, what happened? The Smithsonian Agreement allows currencies to trade within 2% range instead of the 1% previous. In 1981, China allows some people to trade currencies, and South Korea allows free trade of currencies. Then in the 1990s, banks create their own trading platforms, and most important to us, retail forex brokers create internet-based trading platforms. So just a couple of decades ago, we would not have been able to trade this market, but now we can. And that's what this course is about, how to trade this market successfully. That's it for this lecture. In the next one, we're going to go over currency groups. See you there. Welcome back. In this lecture, we're going to go over currency groups and currency pairs. I would like you to turn to the page called Currency Groups. It looks like that. Currencies are categorized into 3 groups: the majors, the minors, and the exotics. The majors are the currencies of the following countries: US, European countries, Japan, Great Britain, and Switzerland. Their symbols are USD for the US, the European countries Euro, EUR, Japan, JPY, Japanese yen, Great Britain, GBP, Great British pound, and Switzerland is the Swiss franc, CHF. For the most part, the first 2 letters of the symbol are the identify the country, and the last letter identifies the currency. Currencies have slang names also that traders like to use, and if you have your print book, you can just jot them down next to the country. The US would be the buck, the euro would be the euro, the yen is the yen, the pound is sometimes called the cable, and the Swiss franc is Swissy. On to the next group, the minors. That would include countries like Australia, Canada, and New Zealand. They also have slang names, the Aussie, the Loonie, and the Kiwi. All the rest of them are part of the exotics group, and you want to stay away from those, so I'm not even going to mention them. They have very low liquidity and large spreads, so they're not suitable for trading. Now there's this other group that's between the exotics and the minors. That is these three. They are part of the Scandinavian group of currencies. The Danish krone, the Norwegian krone, and the Swedish krona. Those are also not traded as heavily as the majors and the other three. So we're going to stay away from those also. Now on to the currency pairs. Turn to the page that looks like this, right there. Currencies are traded in pairs. For example, you buy the yen, but which currency are you going to use to buy the yen? So basically you're buying one currency and selling another currency simultaneously. For example, the US dollar and Canadian dollar pair, the price is going to fluctuate depending on the supply and demand of the Canadian dollar and the supply and demand of the US dollar. Here is a list of the majors: the euro dollar, the dollar yen, the pound dollar, the US dollar Swiss franc, the US dollar CAD, the Aussie dollar, and the New Zealand dollar. Those that don't have the US dollar in them are cross currencies or crosses. They are also known as minor pairs. Here's a list of them. You have the Euro Swissy, the Euro Pound, the Euro Loonie, the Euro Aussie, the Euro Kiwi, the Yuppie, and the Guppy. Swissy Yen, Loonie Yen, Aussie Yen, Kiwi Yen, Pound Swissy, Pound Aussie, Pound Loonie, Pound Kiwi, Aussie Swissy, Aussie Loonie, Aussie Kiwi, Loonie Swissy, Kiwi Swissy, Kiwi Loonie. And everything that wasn't mentioned in those lists are exotic pairs, and you want to stay away from those because the spreads are so large and the liquidity is so less. It's only recommended for position traders, trading very long term, like several months to years. Okay, that's it for this lecture. In the next one, we're gonna, what are we doing next? We're doing Forex sessions. See you there. Hi, in this lecture we're going to go over Forex sessions. Turn to the page on Forex sessions. And so yeah, the Forex market is a 24-hour market, but should you trade anytime during the day? Well, it depends on your strategy. But before we get into that, let's go over when the sessions actually are. The New York session starts at 8 a.m. Eastern Time and closes at 5 p.m. The Sydney session opens at 5 p.m. and closes at 2 a.m. The Tokyo session opens at 7 p.m. and closes at 4 a.m. The London session opens at 3 a.m. and closes at 12 noon. Again, these are all Eastern New York time. If you are a swing trader, meaning you hold a trade for a day or several days, then you can trade anytime during this 24-hour period, and it won't have a significant impact in your performance because the spreads could be higher at certain times, but since you're holding the position for a longer amount of time, then it won't be that significant. On the other hand, if you are a scalper or an intraday trader, then you want to stick to the times that has the most volume, the most volatility, because that's what your strategy is probably going to require. And so what are these times? Well, let's get into it. They are the London session and the New York session overlap. The time between 8, 9 a.m. in the morning to 11, 12. So that 2-3 hour period, that's it. That's all you have. That's the most volatile time during the day. And there is also another overlap that is the Tokyo session and the London session. If you'll see on the chart, if you are overwhelmed by all these strategies, there is a quick way to find out what session you're in. Go to the website forexfactory.com. I have it here. And scroll down to the bottom, and you will have the sessions right there, what your current session is, the local times of the other countries, and that's all you need. That's it for this lecture, and on the next one we're going to go into more Forex terms, what they mean. See you there. Hi, in this lecture we're going to go over some terminology. To begin with, the exchange rate. The exchange rate is the value of one currency expressed in the terms of another currency. For example, pound dollar, the value is 1.3220. That means for 1 pound equals $1.32 in US dollars. The currency pair, pound dollar, has two sides. One side is the base, the other side is the quote. The base currency, which is on the left side, is the pound in this case, and the quote currency, which is on the right side, would be the USD. A pip. What's a pip? PIP. It means percentage interest point. It is the smallest unit a currency can make. There are also fractional pips called pipettes or points. For example, euro dollar, the price is 1.17645. If it moved up 1 pip, it would be 1.17655. From there, if it moved down 1 point or 1 pipette, which is a fraction of a pip, it would be 1.17654. Lot sizes. This is the size of your trade. The type of account that you have, standard account, mini account, micro account, that determines the size, the minimum size that you can trade. In a standard account, that is one standard lot, and that would be 100,000 units. In a mini account, the minimum would be 0.1 lots, and that would be 10,000 units. In a micro account, it would be 0.01, and that would be 1,000 units. Now, there is a bid price and an ask price, and the difference between those two is the spread. The amount that you pay, the retail trader, is the worst of those two prices. For example, if you're planning on going long or buying, then you would pay the higher price, and the spread would be collected by your broker. Going long or going short. Long or going long means you're buying, means you're expecting the price to go up. Going short means you're selling, shorting, like shorting the market, that means you're selling. Now, for new traders, they're sometimes confused about the long and short. It doesn't mean the amount of time that you hold a position. It just means whether you're buying or selling. Leverage and margin. A leverage of 2 to 1 means a margin of 50%. So that means you'd have to put up 50% of the value of the position that you're in. A leverage of 50 to 1 would be a margin of 2%, meaning you'd have to put up only 2% of the position. So for a 100,000 unit position, you'd have to put up $2,000 if you're trading a US dollar account. For a leverage of 100 to 1, the margin is only 1%, and so on and so on. Now, in your account, you have a margin used and a margin available. If you use too much margin and the trade goes against you, the broker may automatically close your trade if it falls below a certain amount. That depends on the broker. Usually it's 50% of the amount of margin that you used initially. That's it for this lecture. In the next one, we're going to go over who are the market players, the market structure. That should be a fun one. See you there. Hi. This lecture is going to be on market structure and players. Turn to the page that says market structure and players. It looks like this over here. We know from a previous lecture that the Forex market is a decentralized market, meaning there's no exchange. So how does this market work then? Well, at the top of the structure are the major banks. They trade with each other directly, or they trade via EBS and routers. EBS would be the electronic brokering services. And the difference between the two is some pairs have better liquidity on one over the other. The banks that are included in this category are Deutsche Bank, UBS, Barclays, Citigroup, Royal Bank of Scotland, JP Morgan, HSBC, Credit Suisse, Goldman Sachs, and Morgan Stanley. After that, you have the smaller banks and medium-sized banks. Then after that, you have the retail market makers, retail ECNs, hedge funds, commercial companies. This is where your Forex broker will be. Then at the bottom are us retail traders. In this pic, it illustrates exactly where our position is in relation to the rest of the market. It's a picture from the book Forex Survival Manual. You should have this a PDF also, or the print if you have that. The little red fish would be you. Now, all these banks at the top, their spreads are not the same spreads that we get. Their spreads are very minimal, and sometimes they have no spreads at all. And other times, the market maker might even take a hit on filling the order. Also, all of these, regardless of where they are, speculate, meaning they trade the market. Now, you might think that the ones on the top might have some special tools available to them that everyone else doesn't to give them some advantage. They might have some, such as order flow or others, but that you can get with some brokers also. But from what I've heard from institutional traders, they don't really give them that much of an advantage. In fact, most of them don't even use them. They actually use the same information that we use. They don't even pay much attention to their own house analysis. They're looking at the same charts that we're looking at, meaning they're not getting any special education that the banks are providing them. They're getting the same thing that you're getting in this course. In fact, they could be watching this course right now. Their bosses could be recommending them to watch this course. So you're on the same field there. The only advantage they have is that they can hold their positions much longer than we can. If a trader at one of these banks balances out his losing position with other winners, then at the end of the year, if he still meets his budget, then he'll be okay. They do have one disadvantage that we don't have, and that is they have to be in the market at all times. If they don't have any open positions while the market is active, their bosses are going to be upset. So they have to be in a trade. Unlike us, we can stay out of the market if we don't like what we see. I'm going to put this picture back up. Remember, this is a decentralized market, so all these big fish out there, they don't know what the exact volume is. They're looking at the same charts that we're looking at. So if you just stick with some basic principles that we'll cover later in this course, then you should be okay in this shark-infested waters. That's it for this lecture. In the next one, we're going to go over Forex orders, different types of orders that you can place. See you there. Hi, welcome back. In this lecture, we're going to go over Forex orders. If you want to follow along in your book, turn to the page that looks like this, Forex orders. There are 9 types of orders that you're probably ever going to use during your Forex trading career. 5 of them are entry orders, 4 of them are exit orders. Your entry orders are market order, a buy stop, a sell stop, buy limit, and a sell limit. Your exit orders are a stop loss, a trailing stop, a close at market manually, and a take profit. For the market order entries, you would get your order filled at the best available price. During high volume times of the day, that's going to be a decent price, small spread. During low volume volatility times of the day, it's going to be a larger spread, so you might not get filled at the price that you wanted. For a buy stop, that is, say your current price is here and you're expecting the price to go up, but you don't want to enter that order until at a higher price. So you would put a buy stop over here. The current price is here, your buy stop order is here, and then the price goes up or down from there. Your order gets hit over here. For the sell stop, it's the opposite. You're expecting from the current price, the price to go further down this level, so you place your sell stop over here, and then it would keep going. Or for your buy limit, say the current market price is here, but you don't want to enter here. You want to go long, you want to buy, but you don't want to enter here. You want to wait for it to come down a little more. So you would put your buy limit stop here. Then when the price falls here, your order will be executed, and then it'll go up from there. For the sell limit, it's the opposite of the buy limit. Say the current price is here, you want to sell, so you will put your sell limit price here, and then when the market hits your price, it'll execute and drop or keep going, and you'll be in loss. For the exit orders, the stop loss, say the current price is here, you placed a buy order here, you expected the price to go up, instead it went down. So to prevent a catastrophe where it drops suddenly way down here, you place a stop loss order right here. So when it hits that, you're out of the trade. It's a loss, but you saved yourself from further losses. It could bounce up, but at least you have some peace of mind there. For the trailing stop, say you placed a buy order over here and the price continues to go higher as you expected, but you don't want to get out right away. You want to see how high it can go. So instead of just placing a market exit over here, you just place a trailing stop, say 50 pips or whatever you decide. So if it drops 50 pips from where it's at, then your trailing stop order will execute and take you out of that trade. For a take profit order, say the price is here, you bought and you expect the price to go here. So you put your take profit order over here. The price continues up, hits your take profit, and you're out of the trade. For the close order, you just hit the close button on your platform and you're out of the trade at the market price. Now, out of all these, the close order manually and the open at market order are the two manual trades. Everything else, you set a price level, and if it hits that level, then it gets executed. That's it for this lecture. On the next one, we're going to go into how to choose a Forex broker. See you there.